Welcome to the deep dive. Right now, the most advanced software companies in the world are coming to a pretty shocking realization. I mean, they are building AI that can write intricate software code or pass medical board exams.
Yeah, or even generate entire films from just a single text prompt.
Exactly. But their biggest existential threat isn't a rival algorithm. It is actually a lack of copper wire and power transformers.
Right. It's really a profound structural mismatch. We are witnessing this unprecedented global acceleration in AI investment and capability. But the physical infrastructure required to actually run that AI, specifically the global electricity grid, moves at a drastically slower pace.
Which is wild to think about. So today's topic is that growing friction between AI infrastructure expansion and our physical electricity systems.
That's right. And we're going to examine that tension through the lens of AI expansion, electricity systems, and structural resource constraints.
Because our mission today is to look past the emotional hype of the daily news cycle that you see everywhere, we want to understand the hidden structural forces actually running the world right now.
And to do that, our source material today is drawn from an analytical framework known as MGF Week 11.
Right. And for anyone unfamiliar, MGF stands for Macro Global Framework. It's an analytical lens that completely ignores surface-level narrative drama. Instead, it reads global events by tracking what it calls gradients.
Yeah. Gradients are essentially underlying shifts in physical resources, institutional mechanisms, and structural tensions. This framework tracks structural patterns over time.
So how do we break this down for today's topic?
Well, we'll examine this dynamic through three distinct structural layers. First, we will look at the physical reality of AI infrastructure growth.
Okay, the actual hardware.
Exactly.
Right.
Second, we'll examine electricity and grid capacity limits. And third, we'll look at capital allocation, meaning how financial markets are fundamentally mispricing this reality.
And we should note, the goal here is to focus on systemic incentives, not to make wild predictions. We want to look at the structural roadmap.
Precisely. We are looking at gradients, not prophecies.
Okay, let's jump into that first layer. Because to really grasp this, we have to shatter what the framework calls the capital misunderstanding.
Yeah, that's a crucial concept to start with.
Right. Because when you or I use an AI app on our phones, it feels completely weightless. It's just, software floating in the cloud somewhere.
Feels like magic.
It does. But behind the scenes, AI is not a lightweight digital product. Structurally, it is behaving exactly like a massive resource-heavy infrastructure project.
And that weightless illusion is incredibly persistent in the market right now. People are treating AI like the software boom of the 2000s or the mobile app boom of the 2010s.
Right, where you could scale a product to 1 billion users with some smart code and a few server racks.
Exactly. But AI models are entirely different beasts. They run on GPU's graphics processing units.
And we should clarify why that matters for you listening. A standard computer CPU is a generalist. It does a little bit of everything sequentially.
Yeah, one step at a time.
But a GPU, on the other hand, is a massive, power-hungry math engine. It's designed to process thousands of calculations simultaneously. That is what AI requires.
And when you pack tens of thousands of those GPUs into a single data center to train a new AI model, they consume an immense amount of electricity. And they generate staggering amounts of heat.
Oh, the heat is unbelievable. So you aren't just powering the computer chips. You have to build industrial-scale liquid cooling systems just to keep the building from literally melting down.
Right. A modern AI data center essentially operates like a heavy manufacturing plant.
Hmm.
Historically, this doesn't look like the dot-com era at all.
What does it look like then?
It closely resembles the 19th century railway boom, or the rollout of the early electric grid, or even laying transoceanic telecom cables. It's heavy physical infrastructure.
Which brings us to a really fascinating concept from the framework called shear, S-H-E-A-R, like wind shear in aviation.
Yes, that velocity mismatch.
Right. It refers to the immense pressure created when two different layers of a system are moving at entirely different velocities.
And this velocity mismatch is the core structural pressure we need to analyze. Let's break down the actual timelines here. In the short term, AI demand and the capital flowing into it operate on roughly a 1 to 2 year cycle.
Because software can be updated and scaled incredibly fast, and venture capital demands rapid movement.
Exactly. But then you hit the physical layer. The medium-term timeline is the data center construction, which takes about 2 to 3 years.
Okay, so that's slower, but still somewhat aligned with tech investment cycles.
Yeah, they can kind of work with that.
Yeah.
But then you hit the long-term absolute physical limit. the power grid.
Oh, right.
Expanding regional electricity capacity, getting the environmental permits, acquiring land rights, manufacturing high-voltage transformers, and actually laying the transmission lines. That often takes 10 or more years.
10 years versus a 1-year software cycle. It's an absurd disconnect. It's like buying a fleet of cutting-edge electric bullet trains on Amazon with overnight delivery, but realizing the government permits to lay the actual steel tracks take a decade to approve.
That is a perfect analogy. The fast train is inevitably going to slam into the unbuilt track.
So if we look at the third structural layer you mentioned earlier, capital allocation, how is the financial world reacting to a 1-year demand cycle colliding with the 10-year physical reality?
Well, currently, they're suffering from what the framework terms a compatibility error. We have a clash between two fundamentally different operating systems.
Okay, unpack those two systems for us.
On one side, you have the capital OS, that's the world of equity markets, venture capital, and quarterly earnings. It is built entirely on the expectation of speed, short-term returns, and infinite scalability.
And on the other side, you have the infrastructure OS, the world of local utility companies, physical supply chains, and heavily regulated government bureaucracies.
Precisely. The infrastructure OS is inherently slow. It is engineered for safety and reliability, not speed.
Right, you don't want your power grid to move fast and break things.
Exactly. You cannot force a 10-year physical engineering project to conform to a 1-year financial expectation. The system will simply reject it.
But let me push back on that for a second. The tech companies driving this, Microsoft, Google, Meta, Amazon, they are sitting on historically unprecedented piles of cash. So if the public grid is too slow, why don't they just bypass the infrastructure OS entirely? We constantly hear about tech companies looking into building their own private solar mega farms or funding small nuclear reactors to power their specific data centers. Doesn't infinite money solve the speed problem?
That's a logical assumption. But money doesn't alter the speed of physics or bureaucracy. Even if a major tech firm decides to fund a private nuclear reactor, they still hit the infrastructure OS wall.
Because of the regulations.
Exactly. The regulatory hurdles, the Nuclear Regulatory Commission approvals, the local zoning laws, the sheer lack of specialized labor to build these facilities, it still takes a decade.
Wow.
Furthermore, there is currently a global supply chain shortage for things as mundane as high-voltage electrical transformers. You can't just buy those off the shelf. There's a multi-year backlog.
So even privatizing the power supply doesn't fix the shear. It's like a Silicon Valley venture capitalist who expects a 10x return in 18 months, sitting in a folding chair in a high school gymnasium, trying to explain to a local Ohio zoning board why he needs to build an industrial substation next to a residential neighborhood.
Yeah, they fundamentally do not speak the same language. And that friction is exactly where the gradients begin to shift.
Okay, explain that shift.
Right now, short-term AI investment momentum continues forward. Everyone is focused on the front end. AI requires GPUs, which require data centers. But the framework projects a severe backward pressure building in the medium term.
Backward pressure.
Yes, specifically in the 2027 to 2032 window. They call this the AI power shock.
Okay, walk us through the mechanics of that shock. How does a power bottleneck actually flow backward into the stock market?
Imagine a massive tech company finishes a state-of-the-art billion-dollar data center. But because of grid expansion delays, the local utility simply cannot provide the necessary gigawatts to turn it fully on.
So it just sits there.
Yeah, that facility sits there, stranded, or maybe operating at only 20% capacity.
$1 billion asset sitting in the dark.
Exactly. When that happens, the capital efficiency of the tech company plummets. They spent billions on infrastructure that isn't generating revenue.
Ouch.
The framework suggests that this won't necessarily cause the AI industry to, collapse into dust, but it will trigger a brutal structural reevaluation of capital.
The market will suddenly wake up to the fact that pure software is useless without the power to run it.
Right. The money will panic, and then it will pivot. Capital will dramatically shift away from pure AI software valuations and intensely refocus on the actual bottleneck, which is energy infrastructure.
So utility companies, grid technology, copper mining, and power generation, they suddenly become the most valuable, strategically critical assets in the entire system.
That's the structural gradient shift.
Yes, that is a massive paradigm shift. It means we have to stop looking exclusively at cloud architecture diagrams and start looking at a physical map of the world.
Absolutely.
Because if hardware and energy are the ultimate bottlenecks, geography suddenly becomes the most important factor in technology.
Which brings us to the deep structural layer of this tension, the geopolitics. The MGF framework maps out what it calls the AIOS Alliance.
Okay, let's unpack that. What is the AIOS Alliance?
The physical hardware that makes all of this AI possible, the advanced semiconductors, relies almost entirely on an incredibly concentrated supply chain involving just 4 key nodes:
And those nodes are?
the United States, Taiwan, the Netherlands, and Japan.
And the mechanism there is highly specific, right?
Yeah.
It's not just that they all happen to make computer parts, they each hold a completely unique puzzle piece.
Exactly. It's a hyper-specialized chain.
The Netherlands builds the ultra-precise lithography machines, right? The lasers that carve the chips. Japan controls the specialized chemicals and photoresists required for that curving. Taiwan actually manufactures the physical silicon at scale. And the US drives the overarching architecture and software design.
It is a profoundly interdependent, tight-knit alliance, and the framework identifies the stability of this specific geographic network as the single biggest geopolitical vulnerability of the AI era.
Because if one link breaks, the whole thing stops.
Right. If any one of those 4 nodes is disrupted by a trade war, a natural disaster, or military action, the entire fast-moving AI infrastructure immediately stalls.
But wait, I have to challenge the premise here regarding the other side of the equation, the energy side.
Okay.
The framework contrasts this concentrated AIOS alliance with what it calls the Energy Logistics OS, and that's heavily centralized in the Middle East, specifically around the Strait of Hormuz, right?
Yes, that's correct.
But if you look at the major U.S. tech companies building these massive data centers in places like Texas or Virginia, they are running on the domestic U.S. power grid. They use American natural gas, domestic renewables, local nuclear power.
Right, the local grid.
So why does the Middle East Energy Logistics OS structurally threaten the AI boom if the power is generated locally in the U.S.?
It's a crucial distinction, and the mechanism connecting them is global fungibility and supply chain logistics.
Fungibility, meaning it's all one big pool.
Exactly.
Right.
First, the global energy market operates as a single interconnected pool. If there is a severe shock in the Middle East and the Strait of Hormuz is compromised, global oil and liquefied natural gas prices don't just spike locally, they spike everywhere.
I see.
That massive inflationary shock destroys the available capital that tech companies need to fund their multi-billion-dollar expansions, regardless of where the data center is actually built.
The cost of capital just goes through the roof for everyone.
Exactly. But the second, more direct mechanism is the manufacturing of the hardware itself. The U.S. might power its own data centers domestically, but remember the AIOS Alliance. Taiwan manufactures the vast majority of the advanced chips.
Right.
Taiwan imports over 97% of its total energy requirements. They heavily rely on seaborne deliveries of liquefied natural gas and coal, much of which is tied to Middle Eastern stability and secure maritime logistics.
Oh, wow.
Yeah. So if the Energy Logistics OS breaks down, the foundries in Taiwan cannot power the factories that build the GPUs. The AI supply chain is fundamentally tethered to global energy stability.
That makes perfect sense. The energy might be local to the data center in Virginia, but the birth of the hardware requires global maritime energy security.
You can't separate the two.
Which brings us to a really glaring psychological question for you listening. If the framework is correct, if we have a looming 10-year power grid bottleneck, a fragile 4-nation semiconductor alliance, and a global energy system constantly on the brink of geopolitical tension, why isn't the market panicking?
It's a great question.
I mean, why do the major stock indices look so remarkably stable, and why are tech stocks still soaring?
This brings us to the mandatory structural inertia layer of the framework. We have to address why visible, catastrophic change has not yet occurred.
Right. Why is everything so quiet?
The sources describe the current global state as being in an absorption phase.
An absorption phase. Okay, this is where we need a really clear visual. It's not a hardening membrane or a calcified bone. It's more like a tectonic fault line snagged on a massive rock.
That's a great way to picture it.
If you stand on the surface, everything looks perfectly still. You don't feel a tremor. The markets are calm. But miles beneath your feet, those massive continental plates are pushing against each other. The pressure is mounting exponentially every single day. It is a silent, invisible tension.
That tectonic analogy captures the dynamics perfectly. The framework emphasizes a vital principle here. Stability does not necessarily mean equilibrium.
Say more about that.
Right now, the system is demonstrating delayed price pass-through. The massive costs of this impending electrical bottleneck are currently being distributed and absorbed by the immense capital reserves of the tech giants.
So they're essentially buffering the shock for now.
Exactly. Additionally, the reality of electricity constraints has not yet crossed over to become a dominant mainstream political agenda item. The capital markets are still operating on the expectation that software scales infinitely.
They're looking at the calm surface of the ground, completely ignoring the tectonic stress building underneath.
Precisely. We are in a latency phase. The tension between the high-speed tech narrative and the low-speed physical reality is building up quietly.
It is building.
Yes. The event itself, the sudden spike in energy prices or the stalling of a major AI project, hasn't happened yet. But the structural gradient is mathematically certain. Data centers are currently being built significantly faster than the transmission lines required to power them.
So, for you listening, next time you use a chatbot to summarize an email or generate an image, remember that behind that weightless instant response is an incredibly loud, intensely hot, power-hungry industrial warehouse.
Yeah, a massive warehouse.
And that warehouse is slowly draining the capacity of a power grid that was designed half a century ago. The physical world is quietly preparing to collect its toll.
And here is where the gradient becomes unmistakably visible. In the short term, the AI expansion narrative will continue to dominate.
People will still be hyped about the software.
Right. But as we move into the medium and long term, systemic incentives will fundamentally shift toward energy infrastructure. The structural slope is moving away from code and toward copper, transformers, and gigawatts.
That is fascinating. Okay, let's compress this entire analysis down into one clear structural takeaway. The hyperspeed expansion of artificial intelligence is currently pushing against the absolute physical limits of global electricity systems and resource supply chains.
Exactly. And the current directional gradient is shifting capital focus away from software innovation and heavily toward physical energy infrastructure and geopolitical resource security.
Which leaves us with a forward-looking question about the incentives driving our future. If we are entering an era where electricity supply becomes the ultimate bottleneck on advanced intelligence, will the next decade of global superpowers be defined not by who can write the most efficient algorithms, but simply by who controls the most abundant, unrestricted power grid?
It is the defining structural tension of the next decade.
We'll be watching the fault lines. Catch you on the next deep dive.